Welcome to our deep dive on financial advisor credentials. First, we will clarify why long strings of designations can mislead. Next, we will explain which licenses actually matter and why the fiduciary standard is the critical factor. Then, we will outline red flags, specific interview questions, and a simple investment philosophy to look for. Finally, we will test your knowledge with quick quizzes and wrap up with actionable steps you can use immediately. Here is our roadmap. We will begin by exposing the myth of certifications. After that, we will cover the licenses that authorize services. Then, we will compare fiduciary versus suitability standards. Next, we will highlight key red flags and provide a practical interview playbook. We will conclude with a simple, low-cost investment philosophy and 2 short quizzes to check your understanding. Before we proceed, a quick disclaimer. This content is for education only and not financial, legal, or tax advice. Your personal situation may be different, and regulations change by jurisdiction. Therefore, you should consult a qualified professional who understands your circumstances before taking any action based on this video. With that said, let's move forward. Designations such as RICP and even respected ones like CFP can indicate training, but they are often part of a for-profit certification ecosystem and are commonly used as marketing tools. Consequently, the presence of multiple letters after a name does not guarantee ethics, competence, or better results. Competence is an attribute of the individual, not the certificate. With that framing in mind, let's separate credentials from what actually determines your legal protections. Let's contrast certifications with reality. First, letters after a name do not guarantee ethics, competence, or superior outcomes. Second, it's the licenses that authorize specific activities. Those matter for what an advisor is legally allowed to do. Third, the legal duty of care is paramount. A fiduciary is obligated to act in your best interest. Fourth, incentives drive behavior, so examine how the advisor is paid. Finally, a sound process tends to be simple, low-cost, diversified, and focused on long-term discipline rather than chasing market-beating promises. With that context, let's clarify which licenses do what. This table distinguishes common licenses. The Series 6 allows selling mutual funds and variable annuities, typically used by insurance agents or broker-dealer representatives. The Series 7 permits selling a broad range of securities and is standard for broker-dealer reps. However, it does not impose a fiduciary duty. The Series 63 and Series 66 cover state-level laws, with the 66 often combining aspects of 63 and 65 for certain roles. The Series 65 is central for fee-based investment advice as an investment advisor representative, typically triggering a fiduciary obligation under the Investment Advisors Act when acting in that capacity. Note that some individuals hold multiple registrations and can switch capacities. Always verify the capacity in which services are rendered at each moment. Now, let's compare the actual standards of care. On the left, the fiduciary standard requires the advisor to act solely in your best interest, with duties of loyalty and care. This usually applies when the professional is acting as an investment advisor representative under a registered investment advisor. Conflicts must be disclosed and mitigated. On the right, the suitability standard requires only that recommendations be suitable, which can still allow conflicted compensation as long as it is disclosed. Brokerage activities typically operate under the suitability or best interest frameworks, which are different from a pure fiduciary duty. Therefore, verifying the advisor's capacity and legal duty at the moment of advice is critical. Next, let's visualize how to vet an advisor step by step. This flowchart guides you through a practical vetting sequence. You begin by finding a candidate and immediately verify records on IAPD or BrokerCheck. Then, you confirm whether they are registered as an investment advisor representative under an RIA or as a broker-dealer representative. Next, you verify licenses, especially Series 65 for advisory work. After that, request a written fiduciary acknowledgement for the capacity in which they will advise you. You then examine compensation structures, comparing AUM, flat, or hourly fees against commissions. Evaluate their investment philosophy for diversification, low costs, and long-term orientation. Probe their approach to insurance, ideally needs-based with a term-first bias. Assess collaboration with tax and estate professionals. If you encounter red flags, you walk away. Otherwise, proceed to interview and formalize with a written investment policy statement. Here are practical interview prompts. Start by asking whether they will act as a fiduciary at all times and request it in writing. Then inquire about compensation, including your all-in cost. Ask for a concise statement of their investment philosophy. Request details on which index funds, or ETFs, form the core allocation and the rationale. Probe how they use life insurance and when term insurance is preferred over permanent options. Ask about collaboration with tax and estate advisors. Finally, request a sample investment policy statement to see how they document strategy and risk. Be cautious when an advisor leads with annuities or permanent life insurance. Commission structures may bias recommendations toward products that are not optimal for you. A needs-first, term-first approach is usually a more prudent baseline for risk protection. As we continue, let's underscore the characteristics of a robust investment philosophy. A robust strategy favors low-cost index funds, or ETFs, because lower fees mean you retain more of your returns. Broad diversification across geographies and asset classes reduces concentration risk. Rebalancing helps maintain your target risk profile over time, and discipline through market cycles is essential. Be wary of any promise to consistently beat the market. That claim is typically a red flag. Now, let's test your understanding with a quick quiz. Question: which item most directly ties to a legal fiduciary duty when providing investment advice? Options: Series 65, CFP designation, RICP designation, or an MBA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is Series 65. This license typically corresponds to acting as an investment advisor representative, which carries a fiduciary duty under the Investment Advisors Act when the individual is acting in that advisory capacity. Note that a professional may be dual registered and switch capacities, so always confirm the capacity at the moment advice is given and ask for a written fiduciary acknowledgement. Question: which scenario is the biggest red flag? Options: an advisor emphasizing low-cost, diversified, long-term investing, an advisor transparent about AUM or flat fees, an advisor heavily promoting insurance and promising to beat the market, or an advisor providing a written investment policy statement. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the scenario where the advisor heavily promotes insurance and promises to beat the market. This combination suggests commission-driven incentives and unrealistic expectations. By contrast, transparency on fees, a diversified, low-cost approach, and a written investment policy statement are positive indicators. This mind map shows how compensation models connect to potential conflicts and the mitigations that reduce them. For example, commissions can drive product bias, while AUM fees can bias toward asset gathering. Mitigations include a documented fiduciary duty, transparent fee disclosures, and a written investment policy statement. On the client side, actions include asking for total costs, obtaining a fiduciary commitment in writing, verifying the advisor's capacity, and comparing alternatives. The objective is to align incentives with your best interest. Use this checklist as a practical workflow. First, verify records on IAPD and broker check. Next, confirm Series 65 when you are receiving advisory services and obtain a written fiduciary commitment. Then, determine your total cost, including advisory fees and underlying fund expenses. Review a sample investment policy statement to see how strategy and risk are documented. Evaluate the advisor's insurance approach and avoid commission-first sales pressures. Favor a simple, diversified, low-cost investment strategy. Finally, ensure the advisor collaborates with your tax and estate professionals. With these steps complete, you can make a confident decision. Here are the key points. First, designations are often marketing tools and do not guarantee ethics or outcomes. Second, licenses authorize services, with Series 65 typically aligning with fiduciary duty when acting as an advisor. Third, a fiduciary standard provides stronger client protection than suitability. Fourth, be skeptical of insurance-heavy sales and performance promises. Fifth, favor low-cost, diversified, long-term strategies. Lastly, always verify, interview thoroughly, and obtain fiduciary status in writing. To summarize, competence resides in the individual, not the letters after a name. Confirm licenses and the legal duty under which advice is given, rather than relying on titles. Follow the money by understanding incentives and fees. Conduct thorough interviews to reveal process and philosophy. Above all, disciplined, low-cost, diversified strategies tend to outperform promises of market-beating results over time. As a final step, let me leave you with a quick call to action. Thanks for watching. If you found this valuable, please like the video, share it with a friend, and subscribe for more practical guides. In the comments, share your best advisor vetting questions or experiences. Your insights may help someone else make a better decision. See you in the next video.